Hello, YouTubers, friends, compatriots, bootlickers, shields, desolate serfs, peasants, vassals, meat sacks. I'm Useful Idiot. Welcome, and let's go to the world of oil, which of course means let's talk about the entire planet. And so we have this agreement between Saudi Arabia and Russia, which is finally some sort of action as far as trying to control this drop in oil prices. And there's all kinds of conspiracies and theories out there as to why this whole phenomenon happened, but it's all been pretty clear now that China's oil consumption dropped, and then along with that, Russia and India and Brazil, all their oil consumption dropped as well as all their respective economies have gone into a certain amount of contraction. So the price has dropped, and then of course the other dynamic being that U.S. oil production surged, and so part of this was a Saudi play to kind of nip the U.S. shale oil boom in the bud and try and do some damage there and keep their portion of the market. So anyway, now we have Saudi Arabia and Russia coming to some kind of agreement, which is fascinating in itself because this agreement would be pretty tough on Russia if they instigated it. But what they mean is to freeze oil production at its current record levels. So it's not really going to change anything. And part of that that's interesting is another story that came out that said the global oil production has only been curtailed by only 0.1% according to a study. So this oil is just gushing, as they say. But this agreement doesn't really add up to much because the agreement is among countries whose production hasn't grown really. So unless Iraq and Iran are on board, then it's not really going to change too much. So what instigated this? Well, the only theory I have right now is that the Saudis are ripping through their cash reserves, and at the pace they've been, they could go rip through their cash reserves within 5 years. But obviously there's other things in play as well. So let's look at this other story about the global oil production only dropping by 0.1%. It suggests that oil prices will drop even more or stay low for a lot longer because this production levels are going to keep going on. As everyone knows, they're storing it all over the world, and I'll get to that in a minute. But slower production theoretically would lift prices, and but the little slowdowns they have not affected the flow at all. So we've gone from over $100 a barrel down to $27 a barrel last month, and there's a continued talk of $20 to $10 a barrel oil, but we shall see. I think they're going to they've been dive bombing, and they're going to take some steps to pull up, and I think this Russian-Saudi agreement is part of that. So the production mostly fell in the U.S. and Canada, so there has been some curtailing production, as everyone knows, and a certain amount of carnage going on in the Canadian and U.S. Oil industries. But so far, it's been pretty resilient. But I think a lot of people have been very creative about buoying the U.S. and Canadian oil production. In fact, recently I heard that BlackRock was offering some new exotic financial instruments and the new derivatives and new kinds of securities to help buoy the oil industry as it falters. So they're going to cash in on some of this carnage. But right now, everyone is just absorbing the losses and waiting for the price to rebound. So like everything else in the financial world and economics, it's going to be a waiting game. They're going to kick the can down the road and just pray to God that the prices come back up, or there will be a lot more carnage. And another reason why the U.S. is not really concerned about this situation is oil production is only 1.6% of U.S. GDP, while it's 80% of Saudi GDP. So you can see why the U.S. can afford to play this game to a certain degree, and Saudi Arabia really cannot. But the whole picture is kind of a two-faced phenomenon because normally low oil prices are going to boost most of the rest of the real economies, and that's what we're finding now. So now with this economic fragility out there, it's an interesting dynamic all the more because these oil prices have boosted most of the rest of the real economies. Although the fact is, lot of these economies have not boosted. So that says something right there, that all the cost cutting that all these different corporations and operations have gotten from lower energy prices has not translated to the kind of growth we would like to see in the economy and the kind of savings. But on the other hand, the other face of this phenomenon is it wreaks havoc on the energy companies and the financials and banks, because they're all speculating. They've got all these derivatives associated with it, all this leverage, all this debt. Everything's the entire rise of the shale industries built on debt. So at some point, somebody's going to have to pay the piper. But here's a couple other stories that are related to that bring up some other ideas. There's an oil market report from 2016, so just in the last month or so, that the market could drown in oversupply, is how they put it, because of rising global storage levels. And inventory levels are at their highest in 80 years. So that's another reason why they're able to sustain everything with less volatility than there normally would be, because of these exotic ways that they deal with price overflow. So in other words, production keeps increasing, so nobody has to pay the piper, but they got to put this oil somewhere. So pretty creative. So they're going to store oil all over the globe and hopefully ride this thing out. We're up to 490 million barrels in the U.S., the highest inventory level we've had in 80 years. Like I say, and globally, 1 billion barrels have been added to inventory levels just last year. So there is an immense amount of oil out there, and there's various schools of thought on how much more capacity we have. But as it turns out, even though the IEA warns of running out of storage space globally, the fact is it's another cottage industry right now. Everyone's building and finding ways to store oil, and not the least of which is all the ships all over the world that are just holding oil that are parked all over the place. But as Denninger points out so eloquently, when this unravels, there's a lot associated with it that's going to unravel as well. And it's not only oil operations that are leveraged up to their eyeballs and all financed with debt. There's going to be all the margin calls. There's going to be all the associated costs and carnage in the associated industries, not the least of which is shipping. Shipping will be a big part of that. So, and then the debt, like I say, the debt levels, and then the derivatives that are showing up more and more and more. Like I say, places like BlackRock offering ways out to hedge against coming carnage in the oil industry, oil and energy industries, which eventually is going to start catching up with things. I'm sure it's hurting the banks quite a bit, and at some point we're going to see more and more losses realized, although they're certainly getting enough time to try and minimize their exposure, but it might be a little late for a lot of different instruments. And then we also have the Bank of International Settlements that warned that the global oil industry is caught in a self-feeding downward spiral as falling prices cause producers to boost output even further in a scramble to service $3 trillion in debt, a huge amount of leverage. So like I was just talking about, there's a figure you can put on it, $3 trillion in debt that's associated with oil industry, and they're going to continue to glut in order to try and keep prices from falling any further. And but unfortunately, that's not working. And like I also mentioned, the exotic instruments attached to it, $440 billion of oil and gas securities issued just last year. So that's the levels of debt that are being taken on to finance this oil boom that is now a glut, and now leaves us in a pretty precarious position. In the last 10 years, and in fact, $1.4 trillion in bonds have been issued associated with this industry, and $1.6 trillion in loans. So there's your $3 trillion in debt to boost up this oil sector that surged forward and now leaves us with a glut and has the potential to be a time bomb. But the kind of time bomb that we see these days, not one dramatic event, but a slow, unfolding, grinding, painful process. And I'm sure we're going to see more of that, particularly in 2016. So yeah, the Saudi-Russia agreement, more or less a moot point unless they can get everybody on board, which was the Saudis' point originally. They were not going to cut production if nobody else would. So now it looks like a lot of people are going to get on board because they're afraid of the alternative carnage in the finances and the banks and the economic system again. More structural deterioration. I'm a useful idiot. Don't you be one too.